traditional insurance policies will have exclusions, and there's a saying that what the big print giveth, the small print taketh away.
Very true.
And so as we look at these types of captives and do our risk analysis, one of the areas we look at is what current policies do they have in place.
From Rea and Associates Studio, this is Unsuitable, a management and financial services podcast for entrepreneurs, tenured business leaders, and others who are ready to look beyond the suit and tie culture for meaningful, measurable results. I'm Doug Hauser. As the costs associated with owning and operating a business continue to rise, owners are always on the lookout for ways to keep more of their money in the business. One popular place to look is insurance. And while there are a variety of insurance options available, on this episode of Unsuitable, we're going to talk about captives. Specifically, what captives are and how micro-captives and group captives can benefit business owners. Brad Stammler, Vice President of Commercial Property and Casualty with Leavitt Group, is here to explain what these options are, how they can help, and when this option might make sense for your business. Welcome to Unsuitable, Brad.
Thank you. Glad to be here.
Great to have you, and I think this is a wonderful topic for our business owners out there because there's a lot of, I would say, misinformation, right, about captives as well, and certainly a lot that they can learn. So from a high level, talk a little bit about what a micro captive is and what that can do for a business owner.
A micro captive is a single parent captive, which means one person or several individuals may own that captive versus multi-companies. And it allows that business owner to transfer either uncovered risk or underinsured risk into their own insurance company. It's a C corporation, and so that business owner is typically going to be the owner of the captive. And so those risks that are not covered by your traditional insurance programs can be transferred into the captive so that they are pre-funding on a pre-tax basis those risks.
And again, we're talking about insurance coverage here, and where they work well are for risks that maybe are difficult to insure otherwise, or is that kind of a misnomer?
No, that's one of the areas. Traditional insurance policies will have exclusions, and there's a saying that what the big print giveth, the small print taketh away.
Very true.
And so as we look at these types of captives and do our risk analysis, one of the areas we look at is what current policies do they have in place and the exclusions that are in those policies. And we can literally issue a policy that will cover all the exclusions. So for example, every business is going to have a property policy.
Sure.
Every business is going to have a general liability policy. And the exclusions are there for a couple of reasons. One, because it's covered better in another policy. Or two, it's against public policy to insure against that type of thing.
Okay.
So we will issue a policy that says, okay, in the property, we're going to cover all the exclusions that are in that form. So now they really truly have an all-risk policy, where before it was a kind of an all-risk subject to your exclusions.
Right.
And you can do the same thing with the general liability.
Okay. So give us some examples of some things that might be then included in this better type of policy, let's say.
Yeah, so we can cover things like, flood. A lot of times that's a pretty standard exclusion, and you can buy it in the open market a lot of times. But if you get into coastal properties or where there's earthquake risk, you can either totally fund it that way, or you can go into the traditional insurance market, and there may be a carrier, but maybe the carrier is only going to provide coverage in excess of $500,000 deductible.
Okay.
So now we can issue a policy that covers that first $500,000. So instead of having that claim, and that $500,000 coming right out of cash flow and working capital, they can now pre-fund it on a pre-tax basis and have invested it at the same time. And if it ever happens, now they have a choice. They can either pay for it out of their working capital, or they can say, all right, I'm going to go ahead and turn a claim in on this particular type of loss.
Right. Now, you and I have worked with and continue to work with several mutual clients in the construction segment.
Right.
And that's an industry, I think, that lends itself quite well to some policies in the captive world, because there are certain risks within the construction industry that aren't easily covered elsewhere.
Right. Absolutely. One of my favorite stories or examples is we have a client that builds military runways throughout the U.S. and is a successful contractor. And as I was talking to him, and this was probably 8 or 9 years ago,
right,
when I do the risk analysis, my last question to anybody after I go through my questionnaires, and you're listening for answers and thinking what the next question might be, my last question is always, what keeps you up at night?
Right.
And he looked at me and he said, a bad pour. I said, a bad pour? Tell me what you're thinking there.
Yeah.
He said, well, we're going to pour a runway, and if we don't have the texture correct, if we don't have the mixture correct, if the government doesn't like it, then that's back on us, and we got to pay to rip it out, and we got to pay for the new concrete, and we got to pay for the labor to put that concrete in, and that's a $400,000 to $500,000 check. I'm writing Brad, and he
very
said,
costly.
That's what keeps me up at night.
Yeah.
And we chuckled a little bit, but after talking to him and talking about, okay, what's your last 5 years' experience been in that? How often have you been called back? Whether it's warranty work or major repair, we're able to take that information, and as long as we can identify the risk, measure the risk, get an idea on its loss experience, we can then go to our actuaries and develop a premium for that.
Okay.
And they'll definitely actuarially develop, the loss triangles, the curves, all the analytics associated with it, and then they will develop a premium for us as to what he will pay over 12 months in case that risk occurs.
Which is great. This is a mutual client I know you're speaking of now, and he's otherwise generally a very conservative operator, operates within a very narrow scope of work with what they do. So for him to be able to cover that is wonderful.
Absolutely. It protects the company against just a bad year. And again, if something happens, he then has that choice to make whether he wants to pay for it out of working capital or whether he wants to go ahead and file a claim.
Now, a micro captive, a so-called 831B captive, right? There are some limitations. Your premiums that are paid to that have to be under a certain threshold. Is that correct?
I think for 2020, it's in the 2.3, 2.4 area. Million, excuse me, thank you. And it originally, back in the day, the max was 1.2 million.
Okay.
And it went through some legislative changes in, I think it was 16. And there was a compromise that, it had never been changed, so inflation was eating away at that amount. So they took it up to 2.2 million and put a 3 or 4% inflationary guide on it. So it's in the 2.3, 2.4 million right now.
And obviously there are, I know there's been some press around, some so-called bad actors in that sector. Like anything, there are bad actors out there who try to take advantage of the way things are written now. The problem with those, and maybe you can expound on this a little bit, are folks that aren't using that to underwrite real risk, and there aren't real claims involved. They're sort of, for lack of a better term, making up stuff to put in there. Is that fair to say?
Yeah, no, we were happy to see the IRS kind of investigate this. And they kind of came out with what they referred to as a dirty dozen list. And it was listed as a transaction of interest. And because what they were finding is there were captive promoters out there that were literally setting up captives without any risk management approach or concept to it. And they were using it strictly as a tax play. And they got caught.
A tax dodge, in other words.
Exactly. Minimize the tax, don't pay the tax.
Yeah.
Because as with any new business that you set up, you're always considering what the tax ramifications are.
Sure.
And it's just good business.
Right.
And so if you set up an 831B correctly, there can be some tax advantages to it.
Sure.
You can put in up to $2.2 million. You're transferring risk from the corporation. So again, now you're pre-funding on a pre-tax basis. And that captive that you've set up, and if you set it up correctly, there is no tax paid on the earned premium net income of the captive.
Solely paid on the investment gains, correct?
Exactly.
Yeah.
Exactly. So, if you do it correctly, there's benefit from a risk transfer standpoint and a tax advantage too.
Yeah. But the purpose of them, the problem that these bad actors ran into, they weren't trying to underwrite real risk. They weren't looking at it as an insurance product, which in essence it is. You're trying to manage and mitigate risk.
Absolutely. I mean, there's 3 or 4 cases that have been decided in the last 3 or 4 years. And as we read them, you could see that there were some very flagrant actions being taken.
Sure.
For example, there was a case, I think it was out in Arizona, and the captive was put together by an attorney in Georgia.
Okay.
And the attorney had never been face to face with their client. And it was all done via telephone, email.
Yeah.
You tell me how much you want to put away and I'll get you there kind of thing.
Yeah.
So there was absolutely no risk analysis. Another one was client was not happy with the captive manager because for the renewal, his overall premium went down.
Okay.
And he sent an email saying that he was not happy that his premiums went down for the year, which, I've never gotten any emails like that in my career.
It's like us getting an email saying, my fees are way down.
I'm getting
happy.
cheated here. I don't feel like I'm paying enough. Or another example was the captive premium was actually more than his traditional premium, and it was for a policy that was acting as an excess policy.
Ouch.
So again, how do you pay for the higher limits?
Yeah.
Pay more than what the lower limits were for. So there were some pretty flagrant actions going on out there that, again, we were very pleased that the IRS stepped in because these captive promoters were just doing it for the wrong reasons, bad image, and they got caught.
Yeah.
And if you do it right, it works well. And certainly there's no reason to do it any other way than the way they tell you to do it.
Right.
Because it works.
Right.
And you're getting rid of risk, and you're able to pre-fund for it.
Do it honestly and for the right reasons, and have true professional involved in helping you set it up and structure it and all of those things.
And that's key too, because again, we'll spend a lot of time up front on the risk identification and making sure we understand it and the ownership of the captive, and get all the financial information, do our analysis, and then we will send it to actuaries that this is all they do, is work with captives, different types of captives. And having been to their office several times, that's just a different world in and of itself.
Sure.
You think accountants are a little weird. You put that actuary.
Come on now, Brad.
And that's a whole new
You're
ball
calling
game.
us out.
But they do a great job,
Yeah.
and they are looking again at the loss experience, the loss triangles, and they'll even they'll do research into the insurance industry itself and say, okay, here's what we're seeing in the marketplace. And they're going to subscribe to different resources that help them as well. So when we get the report back, it's about 3/4 of an inch thick, and a good half of it is all of the statistical, analytical stuff that we all studied or tried to study in college in our stat courses. And it tells you the basis of what they used and why they used the particular factors. And it's there to legitimize what we're doing.
Yeah.
Because you may be audited.
Right.
And that's what we have to protect ourselves against, is that we did it the right way.
Yeah.
It will stand up with the IRS. The other thing, too, when we do those reports, you're going to have 3 to 5 different audiences that's going to read that. Their CPAs are going to read it. Their bankers are going to read it. Obviously, the client's going to read it. The IRS may read it. But the other thing, too, is typically these captives will be domiciled, whether it's in the U.S. or what we call offshore. And when you send these reports in, they're going to look at these for how legitimate are they. You know, is this just a proposal off the shelf, change the names, and just to solidify that, okay, we can do this? Or does it have some purpose to it? And, professional has really analyzed this thing. And so that is really the majority part of the report that goes into the finance director or the captive director, wherever you might send it, for them to review it and say, okay, I'm comfortable with this. They did their homework. It's done the right way. We'll go ahead and certify and give them a permit.
So there's true risk analysis, obviously, that's performed there and analyzed, and that's very critical to the process. So interesting.
Yeah.
So we've talked a little bit about the micro captive and what that does. Talk a little bit about a group captive and how those work and how they might be a little bit different.
Okay. A group captive, as it sounds, it's typically more than one person. There's a group of companies, a group of individuals. One of the big distinctions besides that, and I'll cover that a little more, is the fact that most group captives are going to provide coverage for traditional coverage. Where, again, the 831B, it's not traditional, it's the ancillary, it's the, again, uninsured, underinsured. It's never going to dabble in, the general liability, auto, workers' comp, unless you're, again, insuring the deductible. So the group captive, depending upon the particular group captive you're looking at, will cover the general liability, the automobile, and workers' comp outside of Ohio.
Okay. So more traditional type of things.
Absolutely traditional. And what you're doing is literally today, if a insured has a policy and it has limits of $1 million, they're getting the policy that says $1 million on the general liability auto. What they don't know is that particular insurance company is going out and buying reinsurance to back them up. So let's say an example, the $1 million limit, they may have what's called a treaty in place that says for every general liability policy that they issue that has $1 million limit, some reinsurance company is going to charge them a particular premium so that they will take that upper $500,000 risk. And the reasons companies do that is to protect and manage their balance sheets. They don't want the large catastrophe, whatever it might be, to all of a sudden, it's not just one insured we have, it's 20. And oh my gosh, we got 20 million at risk here, where with some reinsurance, you're knocking it down to 10. When you think about a group captive, what we're doing, it's the same structure, but where in the traditional sense, you have the fronting company or who's issuing the policy. They're going to keep the first $500,000, and again, that second $500,000 is reinsured. In the group captive, what we're doing, we're going to have a fronting company, let's pick a name, AIG. And AIG will issue the policy. then they will turn around and reinsure the first $350,000 to this group captive.
Okay.
And let's give it a name of Presidio. And so Presidio is owned by individual members, shareholders, insureds that are operating companies that the common denominator is their emphasis on safety and loss control.
Okay.
And they have fantastic loss experience.
Okay.
What we're doing is going out and kind of picking off the cream of the crop, if you will, from the traditional marketplace and saying, okay, if we can get the top, pick a number, 5% of the insureds of all the national branded insurance companies, we're going to be able to take that group, and again, their premiums are going to be developed off their own experience, which is going to be better than the average experience within that national insurance company. So my experience has been when we do that, we are generally going to be able to save them 25 to 40% on their annual insurance premiums.
Okay.
So that's the first place they're going to get benefit.
That's huge.
Yeah. So,
and again, these are best in class type of, from a safety perspective.
They're absolutely best in class.
Okay.
And they've been, screened and interviewed and inspected, and it takes a lot to get into these things.
Mm-hmm.
So that's the first place you're going to see a savings. The second place is, again, we've got this layered approach where AIG is the fronting company. The first $350 goes to Presidio, and $350 to $1 million will go to AIG Reinsurance.
Mm-hmm.
And again, so they've taken the catastrophe type claim out of the captive.
Yeah.
Because those are the hardest ones to predict.
Sure.
So they've done that. So again, back to the first 350, again, we've looked at everything, and that's really where the most predictable losses are.
Right.
So the actuaries, again, can pick a number, and they're going to pick what's called a loss pick.
Okay.
So if you got your general liability, your auto, and your workers' comp, they're going to say, okay, I think that contractor is going to have $300,000 in claims.
Mm-hmm.
They underwrite to a 60% loss ratio.
Okay.
So if that $300,000 represents 60%, then that means my premium is going to be $500,000, and that $200,000 bogey in there is for the operating cost of the captive.
Okay.
So that's kind of how it works from that aspect. So it's at $300,000 that will be kind of put into a bucket, if you will, for that particular client. And I won't go much deeper than that, but there's an A fund and there's a B fund. But that's there to pay your losses. Again, we saved 25 to 40% on the premium. That's the first savings. The second savings or income is as you pay your premiums in, those premiums are invested in your own name.
Mm-hmm.
So versus the traditional market, those premiums go into the insurance company.
Sure.
They're the ones investing. They're the ones getting the returns, and they're getting the benefit.
It's a black box. You never see it.
Never see it again.
Right.
And so again, that's the second place you're going to get is the interest income. Then the third piece is, again, I talked about that $300,000 or 60%. In the perfect world would say, if you don't have any losses, that $300,000 is yours.
Right.
Now, it will take some time to get it back because there's what's called a tail to these types of coverages. It takes time to mature and close out.
Right.
But you will eventually get that, with the exception of any type of claim that would be shared within the group captive. And those are typically on bigger claims.
Right.
Because the incentive of a group captive is, again, to have excellent companies join that do not have frequency issues with their claims, that the real world is the fact you're going to have a big claim every 7 years.
Something's going to happen. You can't always do anything about it.
Right. So you got to have some insurance there.
Yep.
And it's the it's that B, they call it the B fund, where the risk sharing takes place, that will allow the premiums to be deducted then.
Yeah. Well, I think this is awesome stuff, and there's certainly a lot to learn and a lot of potential advantages. I think it goes back to, you want to sit down with a real professional like yourself and make sure you have the conversation and understand, what you can do, the advantages, the risks, and there's great potential assistance here for business owners, certainly.
Right. Yeah, they've got to be open-minded.
Yeah.
There are different options and alternatives out there besides just buying traditional insurance.
Right.
And the key to it is, what are you currently spending?
Yeah.
And typically the group captive is they should be spending at least $150,000.
Yeah.
In those three lines for it to work.
Makes sense.
Yeah.
And I know the experience we've had with mutual clients, some of the ones that I know that do it are some of the most conservative folks that I know. And you would think, wow, this sounds a little out of the box, but it's been a wonderful experience for them. So
they do a great job, protecting the mothership, if you will, that being the captive, whether it's through letters of credits, whether it's through just underwriting.
Yeah.
Safety, loss control, because again, you are with the best in class.
Yeah, absolutely. Well, this is great stuff, Brad, and really appreciate it. Very informative, and for our business owners, certainly hope they want to, have a conversation and maybe think about something that's a little bit different. Maybe they haven't explored in the past. So good stuff. If you want to hear more business tips and insight, or to hear previous episodes of Unsuitable, visit our podcast page at www.reacpa.com/podcast. Thanks for listening to this week's show. You can subscribe to Unsuitable on iTunes or wherever you like to get your podcasts, including YouTube. I'm Doug Hauser. Join us next week for another Unsuitable interview from an industry professional.